Good morning and good afternoon. My name is Andy Kizik, and I'm a Senior Vice President at OTC Markets in the Advisor Relations Group. And today we continue our Thought Leadership Educational Series with a webinar on raising money on the capital markets from an auditor's perspective. I have the pleasure of having Corey Fischer with us from Los Angeles area. A managing partner of the firm Weinberg Company. Corey brings over 25 years of experience as an auditor and brings a lot of value to companies who are preparing to raise capital in our markets. Corey has worked with many OTC companies over the years, and we are delighted to have him as a guest to help companies approach, learn, and find ways to really organize their accounts in preparation for a capital raise in our markets. Corey, thank you for joining us today. And maybe you would like to say a few words before we kick off the webinar. Oh, just one thing before we start, just a housekeeping item. For those of you who are on the line, and you will all receive an email of the current presentation, okay? We'll take questions at the end. You can type them into the chat box. There is also a handout of the Weinberg Company, which can be found in the handout section in the right side of your login for the webinar. We will take questions at the end. They can be typed in, and I will repeat this later. Okay, Corey, welcome.
Thank you so much, Andy. It's great to be able to participate. Good afternoon, everybody. My name is Corey Fischer. As Andy mentioned, I'm managing partner for Weinberg Company. We are a CPA firm based in Los Angeles. We focus primarily on audits of small cap and micro cap companies, particularly with a lot of those companies entering the public markets through the first time, either through some sort of IPO, a direct listing. So we've got a lot of experience. Today, I think we'll try to share with you some of my experiences of what companies go through as they go through this transition from a private company to a public company, and try to walk through some of the things that I've seen that maybe have been some of the pitfalls and some of the problems that these companies have faced.
Corey, before we get started, I think that one of the things that I wanted to kind of direct some of this presentation to is the topics you raise are critical. And if I am a CEO of a micro cap or a small cap issuer, what are some of the things I need to think about when I get started? What are the things, if you could focus on some of those as you go through what the agenda is? You know, I will probably ask some questions along the way, but I'm going to play the role of a CEO who's coming in here. So where do I get started? Tell me a little bit about, you know, the topic and some details on that as a CEO for the first time talking to you.
No, absolutely. I think as you go through this process, you know, probably the most important thing is, you know, understanding the capabilities of your financial management team and developing that infrastructure of financial management people and the people you will need to ensure the proper compliance with the rules of whether it's the exchange or the SEC. You have to look at the changing role of management. You're going to transition from an environment where there's an owner-operator to where you're now going to have to welcome in a board of directors and others that you may not have previously had to work with. You're going to have to develop sound corporate governance, which is not only just good business acumen, but also now is required by law if you're going to be a public company. You know, then we could start looking at actually some of the pitfalls that, you know, I've seen that help sink a capital raise, principally as it relates to some of the accounting issues that could show up, which lots of times as a private company, you're an owner operator, you don't really think about. And then we'll talk about, you know, how you select the right auditor, and also we'll look at some of the different tiers with Andy's help that are within the OTC that might be of interest to each of the participants listening today.
Corey, thanks. I think that as we start, tell me a little bit about, you mentioned in developing your financial infrastructure to talk about your company's capability to manage this. Why don't we just kick off on the next slide? Where I get started about the team. Let's just go right into the details of it.
Sure. I mean, obviously, the most important transition that you're going to make as you go and embark on the public markets is you're going to have a sound financial reporting team, because no matter what exchange that you're on, you're going to have to provide accurate and timely financial statements to either the markets, the SEC, whoever it is. So you really need to have a team that's experienced in preparing these type of financial statements and on a timely manner. You also have to have the right people who understand what's called generally accepted accounting principles, GAAP accounting, which could be significantly different than the accounting basis that most private companies use, which is income tax-based accounting. Accounting for certain transactions is completely different, depending upon, if you're a public company, you have to adhere to not only the GAAP, or you also have to adhere to the SEC accounting rules, and things such as leases. There's new accounting rules there, which you're going to have to treat completely different than if you were a non-reporting private company. You may think when you monitor most companies, when they gauge the operation, they look at sales as the number one metrics, but the accounting for revenue is very complicated and may not be the same type of recognition that you would have as a private company. So all those things have to be, considered as when you look at the team. You have to also have people who understand the type of transactions that you're getting into, the debt and equity transactions, because each of them are very different and each of them could affect the company going public, operating going public too. So those are all types of things that you have to consider.
Corey, let me ask you a question before you continue. Give me a sense of approximately how far in advance, as a CEO/management team of a corporate issuer, should I really start to prepare the financial statements, and what's my timeline thinking? Maybe you can address that as you continue.
Oh, absolutely. As you enter the public markets, most companies are going to be required to present 2 years of audited financial statements. And it's a lot easier if you have those audited financial statements done as you're going. So you may get the audits done prior to your going public transaction, but you really need to have the infrastructure in place during that 2-year period to make sure that you're accounting for things in accordance with GAAP, to make sure that you're building the discipline that's necessary to prepare timely and accurate financial statements. And certainly if you have complexities in your company, depending on the size too, like if you have inventories, because inventories need to get observed by independent auditors. So, you really got to see where the company is, but, you should really start building your financial team and your financial statements, with, a year or two out.
So if we have let's say an 18 to 24 month advance, that would probably be ample time to organize. And I think that's an important point, because most of the CEOs that I talk to from where I sit are like, I need to do it yesterday. So putting it in place in advance is good. Maybe you could talk a little bit about the planning and training that and the last point on your slide as well.
Well, I think the thing is that people have to get into the discipline. Your company, your team needs to get in the discipline of preparing accurate and timely financial statements. And remember, it's not just on an annual basis, it's on a quarterly basis. So you have to really, most of the exchanges, the SEC rules are going to require you to provide financial information on a quarterly basis, probably 45 days after the end of a quarter. And then on an annual basis, it's going to be, 90 days after the end of the fiscal year. So you've got to get the discipline where you could actually close your, the accounting records, and not only close the trial balance, but also prepare the drafts of the financial statements that are going to be needed. And that's a whole other process. So there's a lot of things that go into it. So, you really need to start getting into that discipline, because otherwise, there's a lot of, becomes very time sensitive. You may find yourself, you don't have information, because lots of times accounting information comes out from outside third parties. You've got to make adjustments. You've got to consider capital transactions, things that you've never done in the past, have to get included in those financial statements for the quarter.
So the sooner I talk to my auditor, he will advise me and say, here's a checklist of things you need to kind of reorganize for yourself. And if you have ample time to do that, it'll put you in a much better position to execute on a timely basis. One last question before we go to the next slide is that, could you talk a little bit about what dry runs are and how they're conducted?
Well, a dry run would be exactly, getting into the discipline of having your financial statements ready for, not only, if we have a 45-day window to provide financial statements to outsiders, but that means that you still have to leave time for your independent auditor to review those financial statements. So really, companies got to get in the discipline of closing their accounting records, 15 to 20 days after the end of an accounting period. So, you got to go through that whole process. You got to get the information that may be needed from outside parties, for instance, like in accruals. If you've got a lawyer, you got to find out what their fees are for the quarter. You got to get those accrued. If you had capital transactions, you got to get those accounted for. Those could be difficult. And then you got to actually draft the financial statement. So, dry run is something that's very important, because, once the clock goes live and you're registered or you've got a listing, you're going to have to do that, and those financial statements are going to have to be done accurately and timely.
So 15 to 20 days after the end of the quarter to give ample time for the auditors to do what they have to do, instead of the Thursday night at 5 o'clock. So we want to be timely, orderly, and prepared. Let's move on. Let's talk a little bit about corporate governance. Maybe you can give us a little background and the importance, because from a market perspective, good corporate governance is something that investors and bankers are going to look at. So on the aftermarket side, but as you organize it, why don't you tell us a little bit about the importance of that from your perspective?
No, absolutely. Corporate governance is probably the biggest change as you transition from, owner operator, or, as you enter into the public markets. Because you not only have to embrace the concept that you're going to have others involved in the management and direction of the company, there is also legal rules now out there with the Sarbanes-Oxley laws that kind of mandate what you do. Some of these rules may or may not be applicable to your company. I'm sure most people have heard discussion of Sarbanes-Oxley, and it may have scared a lot of companies off from going public. But Sarbanes-Oxley was enacted, most people know, with the Enron collapse, and it established sweeping changes in the operational, accounting, financial regulations for public companies. And these laws were created to protect shareholders, employees, and the public from basically accounting errors and fraudulent financial practices. Really, the key components of Sarbanes-Oxley is they created, much more corporate responsibility for the preparation of financial statements, created a whole new layer of accounting regulation and oversight, which was the PCAOB, and actually also included the addition of criminal punishment to the preparers of the financial statements. So there were a lot of changes, and there's a lot included in Sarbanes-Oxley. I think probably the two most common things that people are aware of is that there's Section 302, which pertains to corporate responsibility for financial reports. It established that CEOs and CFOs have to review and certify the financial statements, and they now become criminally, responsible for any fraudulent type of transactions or reporting. The second big thing within the Sarbanes-Oxley is Section 404, which deals with management assessment of internal controls. And this is probably the most, troublesome for companies going public. Section 404A, specifies controls over internal controls, financial reporting controls, and accounting disclosure requirements. But it also, that's what most people think of when they think of Sarbanes-Oxley rules, but it also expanded. Companies also have to have a complete other layer of controls too. They have to have entity level controls, which is sort of how is the company run. They have to have board controls. They have to go through a risk assessment process. They have to go through, and there's process controls, and then there's monitoring and self-assessment. And this all leads to, in financial statements, companies have to make an assessment of whether their controls are effective, and that's actually embodied in. This is more in an SEC registrant, but I think a lot of the OTC companies that are not registered with the SEC, also kind of make this self-assessment. Section 404B.
So the fundamental approach, whether you're alternative reporting for OTC or whether you're US GAAP reporting, all these principles apply. And so, we're not even at the point to discuss the capital. We're talking about the underlying organization to be prepared for it. So when you talk about independent directors, and audit committees, I guess, do audit committees need to include a financial expert that needs to be on it, I guess? Maybe you could kind of delve into the importance of that a little.
No, absolutely. I mean, audit committees are a concept. They actually were here before Sarbanes-Oxley, but have become more important in audit committee and public companies since Sarbanes-Oxley, because it really defines what these entity level controls are. The audit committee is ultimately responsible for the completeness and accuracy of the company's financial statements. They actually hire the auditors. When we're hired, we're theoretically hired by an audit committee. Audit committee is a subset of the board of directors. So you may have a board of director of 5 members. A company will appoint 3 members of that to an audit committee. Usually you try to get a financial expert on the audit committee. It is not a SEC rule that you have to have a financial expert. Some of the exchanges do require that they have a financial expert. And they also, the audit committee members are theoretically supposed to be independent, which means, they're outside of management or don't have any ownership interest. So the auditors report to the audit committee. They hire the auditors. They have a very important role in overseeing the accounting and financial disclosures of a company.
Thanks, Corey. It's really important to have that. What other elements under corporate governance would set a good foundation for this? We've talked a little bit about board of directors, audit committee. What else do we have next? Maybe let's flip over to the next slide.
Yeah, I mean, I think the most important element is, you have to, the owner operator, has to change their mindset. And now they are head of a publicly traded company. And they have to operate in accordance with the guidelines for what public companies do. and that's a transition period. I mean, the first thing is you have to realize that as a public company, there's full disclosure. You have to, you can't hide anything. All agreements are going to become public. Salary and wage information becomes public. You have to get approval, theoretically, for all major transactions. There has to be a segregation of duties. Related party transactions have to be approved. And then on top of it, the CEO, the management, they have to be aware of what they can and cannot communicate to the market. There's something out there called Regulation FD disclosures, which will tell, which governs, how companies can release financial information in a way that's fair to all investors and not selectively. Also, there's, CEOs and management have to understand, the type of information that can be released, not really speculative information. And they got to control who it is that's actually saying that information. Lots of times companies, especially if you have investors, they're going to call the CEO, they're going to call the CFO, they're going to say, hey, what's happening with this new contract? And you just got to learn you can't tell them that. So it's a whole change in the mindset and the processes that you do in dealing with the outside.
Corey, so in other words, you can establish, for Regulation FD, the way you want to communicate so you don't disenfranchise any potential investors and build that into your practice, affiliate, non-affiliate transactions. So the more transparency you have in a way to publish that is, if you are an SEC reporting company, obviously you will file with the SEC and it'll get distributed. However, if you're not an SEC reporting company and you follow the alternative reporting standards of OTC markets, you are subscribed and should subscribe to the Disclosure and News Service, which gives you a mechanism to post and disseminate the information in a real-time basis, including financial and corporate disclosure. I think that, when you talk about Sarbanes-Oxley, the idea of creating any type of, when you have accountability from management and what I would call maybe certification of management for the accounts, it adds credibility. So as you make your laundry list of all the information that goes to the investors, I guess the question really comes down to the more transparent you are, the more open the investors will be to potentially investing in your issuer, subject to whatever their parameters are. I mean, your job is really, as an auditor, is to clean up the accounts, make them current, and have an ample time to do that. What happens if you're late with this? What's the ramifications if you don't have this in place?
Well, they're usually late filing. Each of the exchanges has rules. What they do if you're a late filer. There's usually a grace period to get a filing in. They may add a ticker symbol. They may add a letter to the end of your ticker symbol indicating that you're late in filing. It's really up to the exchanges, but ultimately you could be removed from the trading exchange. And then if you don't file, if you're an SEC registrant, then you would have to deal with SEC enforcement for continual late filings. It's more a market penalty, if you don't file. Now, if you are issuing inaccurate press releases or are making violating any of the Reg D rules, then those potentially could be enforcement actions. The majority of SEC enforcement actions, and I know it doesn't even matter, I think, if you're related, if you're traded on the, or a registrant with an SEC, it probably permeates for all OTC companies and non-registrants, is SEC takes press releases very seriously. You saw a slew of enforcement actions recently against companies that made all these claims about, that they had products to, battle COVID. And there was just a whole slew of SEC enforcement actions based upon press releases. So press releases are something that management has to become very aware of and very careful of, and what is being released to the public.
So in other words, if you don't organize yourself early enough, there's a snowball effect, there's a domino effect that can put you in a position to then not have your accounts ready on time. And I gather that if you're inconsistent with being able to report on time, it will be a reflection on the credibility of the company's ability to organize. So it's probably encouraged to, the earlier you start, the sooner you work with the auditor, the quicker you get your accounts in order right at the end of your quarter or annual period, the quicker you'll be able to get the information out into the public. If you're late, the investors will then say, wow, this company can't get reported on time. Is that a reflection of the way they operate the company? And they can make their own insinuations. However, there could be potential reasons why they might be late, such as a pending financial transaction or something like that, which would probably be understood by the market. But these are great infrastructures. Let's talk about the things that maybe go wrong. Could we flip over to the next page and talk about things, what I call the don'ts list, or the pitfalls, or things to be aware of?
Yeah, absolutely. I think probably the number one problem that companies have that could sink a capital raise is not having audited financial statements. Just going back to what we initially said, oftentimes companies in the process of preparing their internal financial statements don't take into consideration or not aware of all the GAAP rules, generally accepted accounting principles, and they could lead to significant differences than what may have been initially presented to whoever you're going to do an equity offering with. So right then and there, that's probably the number one thing. Cause of things going awry. Second major thing that happens is lots of companies have related party transactions, and those all need to be segregated and disclosed, and it's possible they may be distortive on the financial statements if they include commingled transactions. Best example I have is, if you have a brother-sister corporation, and let's say you're making a widget, let's say you make a candle, or you sell a candle, and this company wants to go public or raise capital, and then the owner-operator also has a separate company that makes the candle. Well, you can't just separate those two companies. Those companies, that would be like a commingled operation, and somehow you would have to kind of, bring those companies together. A related party transaction has a lot of scrutiny from the outside. A lot of the concern would be, are those related party transactions at arm's length? You're allowed to have related party transactions, but they need to be segregated and they need to be identified. A related party would be, an affiliate, like a brother-sister company, or maybe the owner, operator, or the board controls another company. Maybe there's a company where it's owned by an immediate family member, or a company where management of the company also owns a percentage of another company. So these are all types of things that have to be considered. And actually, if your biggest customer is a related party, that could be a concern to an investor and also to a regulator. The other major thing that I see is lots of times companies, private companies, owner-operators will have investments in other companies. And these are all legal and fine. The problem is when you start entering the public markets, accounting rules kind of force you to value those investments at a current market price. And if you made a investment in a small company at 20%, you took a 20% investment in some sort of venture, you have to, on a quarterly basis, figure out how to value that investment. And that becomes very difficult. And to take it a step further, you also going to have to analyze whether or not you might have to actually consolidate that investment. So that becomes, a troublesome, because lots of companies do have these types of investments. Another big pitfall is in the cap table. Lots of times companies are very liberal in issuing shares of stock. It could be shares for services. It could be shares for employee compensation. It could be shares to make acquisitions. Now you have a question of how do you value those shares for accounting purposes. Most public companies, when they issue shares of stock, can go and value those shares based upon an existing market price. If you're Apple and you go on to do an acquisition and you give somebody 1 million shares, then it's going to be valued at the traded price, which anyone can easily get by just looking at Yahoo. When you're a private company, you can't do that. So lots of times these acquisitions that may have been done in the past, or these shares issued in the past, become troublesome. Learning how, trying to figure out how to account for them. The other, troublesome thing is when you issue debt or equity. There are lots of terms in those debt and equity instruments that cause accounting considerations. Usually they relate to conversion features, or perhaps in convertible notes, or perhaps you issued warrants that have exercise prices that change, or conversion features that change based upon market conditions. And these create very complicated accounting issues. So these are kind of the top things that from an accounting standpoint could cause issues in doing a capital raise.
Corey, these are great points to make, and I have some comment around that. I see a lot of our issuers in our marketplace on OTC markets conducting a variety of debt and equity transactions, and winding and unwinding them. You explained how the valuation can occur in certain instances in the company assessment valuation of shares, but for a company to come in as a private company having a load of convertible warrants and things like that, is it better for a company maybe to initiate a public accounting process prior to building up that? Would it complicate the matter going forward? What are some of the accounting complexities in debt and equity transactions that you can further talk about?
Well, the biggest thing is exactly what you said in these convertible notes, where companies issue them, and they have conversion features in there that are variable based upon perhaps the market price of the stock, or maybe even some performance elements. And these become very, very hard to value, and they have to get, what happens is that the conversion feature actually becomes a liability, and it has to, you probably almost need an outside valuation company to value that liability, and then each reporting period you have to value that. Oftentimes these are the only types of outside investments that companies can get, so they're kind of in a hard spot. So obviously the best thing is to get sort of a straight financing vehicle, but sometimes they're not available. These types of things, though, they do create problems for a company as they go into the public markets. because first of all, not only the accounting is difficult, but it becomes difficult for the investors, potential investors, to figure out what the fully diluted capitalization of the company is, because these things have an unending amount of shares that could be issued or issuable. So it's a very difficult financing in this instrument, not only for accounting purposes, but actually going forward into a capital raise, because when an investor comes in, they want to know that they're getting a fixed percentage at that date. But with these dilutive instruments, you don't know that, and it becomes, it could become a factor in prohibiting a capital raise in the future.
I've got one more question around asset valuation. Under the U.S. GAAP, how often are companies required to conduct an asset valuation, and what types of assets must they take into consideration? I guess collectability, realizability of overdue receivables. What types of assets do need to go into that, and what can you kind of add to asset valuations that might be helpful for our issuer clients that have dialed in?
Sure. I mean, when we'll break it down into two types of assets, we'll talk about like long-term assets, and then we'll talk about the current asset valuations. And current assets would be things like accounts receivable, inventories, prepaids. Every time you release a financial statement, and in accordance with the U.S. GAAP and also the SEC rules, you have to go through an analysis of the collectability and the realization of those assets. So if you have accounts receivable, inventory, you got to look at the reserves that could be required for uncollectability of those receivables, or the non-sellable inventory, even things like prepaids. This has kind of come to the forefront now too with the COVID situation, because you may have had valid receivables in the past from great customers, but because of what's happening in the marketplace and a lot of failures within companies, maybe those receivables are no longer valid or collectible. So you have to go through on a quarterly basis on the current assets to make sure that there are any realization problems. Long-term assets, it's a little different. Long-term assets are usually things like goodwill or intangibles. You normally do an annual impairment test on those. And that impairment test usually requires some sort of discounted cash flow analysis to make sure that that long-term asset is recoverable in the future. Very difficult to do. In fact, most of the SEC comment letters, PCAOB comments coming out relate to the analysis of these impairment tests. Lots of times for the smaller companies, the problem is that they'll go out and do asset acquisitions, and they'll issue shares of stock. And those shares of stock may be at a current value what the market trading price is. They record that as goodwill, and it becomes the biggest asset on the company's balance sheet. Well, a year later, you're going to have to substantiate the recoverability of that asset, and unless you have some sort of discounted cash flow or some other factor to substantiate the carrying value of that asset, it becomes difficult, and you may actually end up writing off that asset. Interestingly enough, the asset goodwill and other intangible impairments only have to be done on an annual basis, but each quarter you're supposed to assess whether there are any changes in that initial determination. There was actually an SEC enforcement case just recently with a company where they did their annual impairment test, determined that the goodwill was fine, but in the first quarter, because they lost a particular brand and some other factors, that goodwill was impaired. They did not take the markdown in the first, second, or third quarter. They did take it at year end. But the SEC did come back and said, well, you knew that in the first quarter, you should have taken that markdown in the first quarter. So it's very difficult, very subjective.
Thanks. Let's talk a little bit about picking the right auditor. Maybe we can flip to the next slide. Tell us a little bit about the role of a PCAOB. What is it? Maybe describe what the PCAOB Oversight Board really is and does, and maybe you can give us a quick synopsis.
No, absolutely. The PCAOB came into existence with the Sarbanes-Oxley Act. And whereas the SEC oversees the operations and reporting of public registrants, the PCAOB oversees the activities of the auditors who audit public companies. So you have to become a member of the CPA firm has to become a member of the PCAOB before it can audit a public company. Once you become a PCAOB registered firm, you are then subject to PCAOB inspection process. The PCAOB inspection process could, depending upon the number of clients that you have, could either be annually or anywhere up to 3 years. PCAOB, the inspection process is a very grueling process that the firms have to undergo. And at the end of this process, the PCAOB will publish an inspection report, and they will list all the deficiencies that they found in their inspection, and those are all posted on the PCAOB website. If a company has numerous deficiencies in a particular inspection, it usually leads to some sort of PCAOB action against that firm.
Thanks for that. Let's go over to attracting investors. Let's click over to the next slide. OTC markets is a stepping stone for some companies that eventually want to move up towards an exchange and going through that process. And some of the companies that you have worked with, Corey, I guess I would look at it as a preparation or a runway for becoming fully reporting. Although the process is the same for companies who want to join OTC QB or QX, you need full year audited. Interims do not necessarily need to be audited, but OTC QB and QX are considered established public markets, which means that if you're not on OTC QB or OTC QX and you're pink or sub-pink, that means that trailing disclosures are not acceptable for future filings if the company is going to file a registration statement, whereas QB and QX trailing corporate disclosure is and pricing is available to be used as valuation. Otherwise, you'd need a full valuation. What's some of the suggestions, Corey, in general, you would give to a company as they organize and move forward in terms of leveraging the ability to kind of grow into being an SEC reporting company? Because our compliance team really does quite a good job at evaluating and guiding companies. What's some of your experiences with companies in our market that you would shed some light on?
Well, depending upon whether or not you're SEC registered or not, the company's got to get in the, as we said, the discipline of preparing these quarterly financial statements, because theoretically, whether these financial statements are audited or reviewed by an outside independent accounting firm, the financial information being provided to the public should not be different. So once you've made the decision that you're going to get listed, it kind of gets back to what we talked about initially. You got to make sure that you have the people in-house that can prepare accurate and timely financial information, because it's not only the SEC, but the outside investors and the oversight, the protection of the shareholders. If something goes wrong, they're going to look to the accuracy of those financial statements. for litigation purposes, and that doesn't matter that they're audited or not. So, you got to go back to step one and just make sure that when you prepare these financial statements that they're done properly, the disclosures are proper. If you are an SEC registrant, you're going to have to file audited financial statements on an annual basis. Those are audited by the auditors, by a PCAOB registered firm. You're also going to have to file a 10Q, which is a quarterly filing, which has to be reviewed by a PCAOB registered firm. There also are 8K filings, which is where you report a material event that may occur in between the filing of the 10Qs. And also there are, other filings, Form D, shareholder activity that are required to be filed. But, same thing. I mean, those are the SEC requirements, but that's just great governance to follow, even if you're a non-registrant.
Corey, that's a great summary. I just want to make one comment that recently the SEC has put out a rule affecting 15C211 and the impact that will have in our marketplace. So OTC Markets groups its companies into OTCQX, our best market, OTCQB, our emerging venture market, and Pink Current. Companies that are sub-pink, meaning their stop sign or yield signs aren't current. So if you are one of those companies in the audience, you should really start working on getting all your accounts to be current, to pink. Otherwise, at some point, there is discussion under the rule that it would go to a dark market. So this process does take time. So if you do have a stop sign, which means that you've stopped reporting, I encourage you to register with the Disclosure News Service, initiate your audits, get them current. If you can, move to QB, possible move to QX. This would only enhance your positioning in terms of being current in the market. Do we have, just to recap for everybody, if there are any, if anybody's interested, this presentation will be available an email to all of you that have registered for this. It'll also be available online on our website. But if there's any questions, please type them into the chat box and we would be happy to start answering them. Corey, this has been a great summary. Let's see what we have. I have one question that's come up is, let's see, if an auditor falters, what happens to the issuer? Corey, can you give us a quick answer on that?
No, absolutely. If the auditor falters, it's not good. What will happen is the SEC will not allow future filings of those financial statements that were audited by that auditor. So, for instance, if your auditor receives a PCAOB enforcement action prohibiting them from going forward, let's say you're in the process of doing the 2020 audit, and that firm issued an opinion on the 2019 audit. When you file your 2020 audit, it's for 2 years, so you have to have audited financial statements for 2 years. Normally, what you would do is if you would switch to auditors during the year, the prior auditor, 2019 in this case, would issue a consent to file their previously issued audit opinion. PCAOB, SEC will not allow that, so you would have to go back and get those financial statements re-audited. So it creates a mess for the registrant, for the company, no fault of their own, but that kind of goes back to make sure that the auditor that you select has doesn't have any outstanding SEC actions. You got to go look at their PCAOB inspection report, because if that audit firm fails, and there's been a lot of them, PCAOB inspection and enforcement activity has been very, very comprehensive in the last few years in eliminating a lot of firms that service the micro cap market. You're kind of puts you in a very bad position to no fault of your own.
Yeah. I have another question coming up here that says, if I'm a nano cap or a micro cap pink company, roughly under 50 million or so, seeking a PCAOB auditor to facilitate moving up to our the premium market OTC QB or QX. What are the typical costs and processes to achieve an audit? And do we get a discount for the size of the company or the financial statement? Talk a little bit about general cost. I know there's more to it, but maybe you can give our issuer audience a little bit of insight on that.
Yeah, I mean, that's obviously a very common question, and it's all facts and circumstances at that time. Depending upon your revenue, depending upon maybe if you have large inventories, complicated inventories, audit fees can be, vary significantly. There is no real way to estimate that. You really would, as you go out and talk to firms, you get a good idea. My rule of thumb is, number one, you got to find the right size auditor. It's always great to have a Big Four come in, but the fee structure in a Big Four will be completely out of whack, probably for 95% of the people listening here today. At the same time, there are going to be lots of firms out there that are going to tell you they could do it at a bargain basement price, and that's exactly the type of firm you want to avoid, because those are the ones that are, cannot possibly be doing what the PCAOB wants them to do. And that's why there have been so many enforcement actions against a lot of these smaller firms. But on top of the audit cost, legal costs are going to be there. You're going to have to employ an SEC counsel. You might need to bring in a lot of people, investment advisors, to help manage the outside market communications. There's a substantial annual cost. I mean, I would think for even the smallest companies, you're going to cross over to $75,000 to $100,000 all combined. You have to pay for Edgarizers. So
that's very helpful, because there's also legal fees and accounting fees that go along with being public. There's a responsibility for the issuer to do that. I've got another question coming in. It says, is it an issue if there are advancements to an affiliate company for subcontracting or for similar reasons for that? So the question is, I'll repeat it again, is it an issue if there are advancements to an affiliate company for subcontracting or having a similar reason for that?
Well, that's an interesting question, because I think it kind of touches two things. The SOX specifically prohibits certain related party transactions, which were abused in the past. The number one thing is, there's no more loans or advances to shareholders or company officers. If you're a private company, that was kind of what you used to do for tax planning purposes. You would give an officer an advance, call it a loan. You can't do that as a public company, nor can you theoretically make an investment or an advance in an affiliated company. Prior to SOX, there's lots of small micro-cap companies that were raising equity. They might raise $4 or $5 million, and then the chairman would take $1 million and invest that in another one of his related companies. Unless there's a real business purpose for that, that is something that would come under business scrutiny, would come under the scrutiny of the SEC. In this particular case, if there is a business reason for, if he's using this company's subcontracting with a related party, it's really more of a related party transaction, and you would just have to understand the business purpose of that. And, it's a difficult question, but that's certainly something you're going to have to discuss with your auditor and also your, perhaps your SEC counsel.
Thanks, Corey. I've got another question coming up in the box, which says, what are the general advantages or disadvantages of staying fully reporting in the OTC pink market? Do you have any insight to that?
What are the well, the advantages of staying fully reporting is just confidence in the financial statements, and that the investor knows that there's going to be accurate and timely, consistent financial information coming from that company. I mean, the worst thing that can happen to investors is, if they make an investment, all of a sudden that company goes dark.
Yeah,
They don't know what's going on.
exactly. And I think that what happens when a company goes dark, you will find that the investment community, the broker-dealer community, has over the years recognized the upper tiers of OTC markets for maintaining a requirement to be fully disclosing of corporate and financial disclosure. As I mentioned earlier, OTCQB and OTCQX are considered established public markets for purposes of future S1 filings, which means that current and trailing disclosure is recognized by the regulators. Pink is not. I think that getting organized for having your accounts current, OTCQB and QX require full year annual audit, but interims do not need to be audited. And there's other advantages of due diligence that our compliance team at OTC Markets conducts, raising the bar for interest in investment by small, medium funds, family office networks, and tradability. We are now coming towards the end of our time, and any questions that did not get answered, we can pass on to Corey. Corey, thank you so much for coming and giving us a glimpse of the auditor's perspective in preparing for raising capital. I want to thank you, Weinberg Company, and others who made this possible. Again, there's a handout section that you can download about Weinberg and Company. There's also a presentation that will be made available to you. This presentation will also be available on our website in a day or so. Corey, any last words?
No, thank you. I appreciate the opportunity of speaking with you. And, I look forward to an interesting year going forward. The market seems to be holding up, so let's all hope that they continue that way.
Thank you very much, and we're signing off on our thought leadership series for raising capital, raising money on the capital markets from an auditor's perspective. Thank you all for joining us, and have a safe and happy holiday season.